If you've made a pact with yourself to grasp tighter on your own financial stability this year, you may have decided that you want to learn to trade or invest. All of a sudden, you're plunged into this new world of spreads, positions, bulls, bears, and trends. It's a real learning curve in itself just to understand what everybody's talking about when it comes to the stock market. And in my opinion, it's a really important job to learn the basics of the terminology before jumping in financially. As such, here are 10 investment terms for beginners in the stock market in 2020. Number 1 is share. A share is a unit of ownership in an investment. Your share of an asset that you've deemed attractive enough to put your own money into. When you invest or trade, buying and owning shares in a specific company or organization technically makes you a part owner of said company, and as such integrates you into the wins and losses of it. This is how you make or lose money as a shareholder. The price per share is usually determined by the supply and demand balance of the asset that you've invested in. So if business is good, the share price will usually rise alongside profits. If, on the other hand, the stock or service is too high in comparison to the demand for it, sales could drop and the share price generally will fall too. Unless you're investing a lot of money and buying up huge numbers of shares, the ownership percentage you hold is minuscule, and as such you will not be involved in the day-to-day business of the company. Number 2 is portfolio. Similar to how an artist's existing works make up their portfolio, an investor's existing assets make up theirs. Portfolio is the term given to an individual or an organization's collection of investments. This could include shares, commodities such as gold and oil, cryptocurrencies like Bitcoin, properties, and more. The main goal as an investor or trader is to build a profitable portfolio. Number 3 is position. A position is the term used for holding a stock in an investment. When you buy a share in a company, you are taking out a position with them. There are 2 main types of position, a long position and a short position. A long position is where you purchase shares in a company or commodity in hopes that over time they will do well and increase the value of the share price. This means that as time progresses and the company grows and turns a profit, your initial investment will become more valuable, allowing you to sell at a profit. A short position is kind of the opposite. In shorting a stock, you are betting on it losing value. Shorting is a process where you borrow shares of an asset at a certain price to sell at the current value without really ever owning it. You hope that over time it drops in value so that you can buy the shares back at a lower price and take the difference as profit. This is a really risky game, however, because if the stock grows in value instead of drops, you as the trader are liable to buy the stock back at a higher price than what you shorted it at, and in turn owe the difference from your own pocket. On larger scales, this can easily result in the trader bankrupting. Shorting is a technique recommended only for those with more experience in trading, who can viably research the market and make their own choices based off the back of that. Term number 4 is spread. A spread is the difference between the buying and selling price of a share, commodity, or cryptocurrency. There will always be a usually small difference in price, and this needs to be considered when taking a position with a company, because the difference in spread needs to be made by the stock growth before you make any profits. The difference between the buy and sell price of a share is usually taken as a fee by the broker who handles the transaction. The spread size itself tends to be dictated by the liquidity of the stock being traded. The more frequently bought and sold a stock is, the smaller the spread tends to be. Numbers 5 and 6 are investor and trader. There's a common misconception in trading that investing in the stock market makes you a trader and trading makes you an investor. There is a stark difference between the two, and each has their own benefits and fallbacks. Commonly, an investor is somebody who invests their money into a stock or asset in hopes that over time it will become more valuable. It's a slower process with less risk, assuming that the investor has done their due diligence in researching what companies to put their money into. It's a relatively non-stressful strategy, relying on long periods of time to pass in turning profits and returns on the initial investment. A trader, on the other hand, is more likely to be seen sitting in front of multiple monitors, displaying up-to-date news feeds relevant to their portfolios on a daily basis. Traders are more hands-on, making lots of smaller transactions in a shorter period of time in hopes of making quicker profits. The upside to this method is that, done well with proper research, a trader can turn profits fast and frequent. The downside is that both the risks and the stress of involvement are arguably higher, and money can be lost as quickly as it can be made. A well-researched trader can, however, make a full-time living from day trading, whereas an investor is more likely to be building a portfolio alongside another job. Number 7 is trends. A trend represents the general movement of an asset's share price. At the total analytical reduction, a stock's price moving upwards over a period of time is known as the uptrend, and a stock's movement downwards is known as the downtrend. It's really ever that simple, however, and fluctuations do occur at all times in both ways. More practiced traders can make educated predictions of trends using technical analysis, a homogeneous and complex system of indicators that measure the strength of share price movements, allowing for seasoned eyes to notice reoccurring instances. Number 8 is dividends. Dividends are only really relevant to investors taking long positions in the stock market. They're a relatively easily attainable means of passive income, paid to you on a regular basis purely for holding positions in the companies that you've chosen to put your money in. Paid anything from once to 12 times a year, a dividend is a share of the company's profits, paid out to its investors as an incentive to keep them on board. Usually this is in the form of a cash dividend, where money is the payment. Less frequently though, the dividend can be paid out in extra stock shares, known as a stock split. Dividends aren't paid by every publicly traded company, so it's really important to undertake valid research if you're looking to earn money from a dividend portfolio. The amount, frequency, and terms of the dividend can be changed at any point by the company. So as always with the stock market, risks can never be totally mitigated. Term 9 is penny stocks. Penny stocks may be a term that you've heard before. They are stocks that trade at less than $1 per share, though other definitions will have that set at $5. Penny stocks hold potential for huge movements, either up or down in value. As such, they're popular with day traders looking to turn quick and consistent trades. Imagine two different stocks, one priced at $1 per share and the other priced at $100 per share. If both stocks increased in value by 10 cents per share, the penny stock would see growth of 10%, while the $100 stock would only see growth of 0.1%. In this example, you would make significantly more in profit with the penny stock. This, however, also works in the other direction. It's much easier to lose larger sums of money with penny stocks as a result, making them a riskier trade and for more researched and seasoned traders. And finally, number 10 is compound interest. Albert Einstein once famously stated that compound interest is the eighth wonder of the world. Compound interest is the process of reinvesting profits and dividends to compound the growth already made into further profits. Imagine hypothetically that you own an investment portfolio that pays you $50 every 3 months in dividends. So to compound, instead of withdrawing that $50 to spend, you reinvest it into more shares that will then in turn give you more quarterly dividends. You then reinvest those dividends and so on. What starts as a fairly slow process will eventually grow exponentially and dramatically speed up the growth of your portfolio. Any profits made through trading can be reinvested into more holdings as opposed to withdrawn and spent. The longer that you can personally practice self-control and hold off withdrawing your profits to spend on material items, the quicker your portfolio will grow. To anybody watching who is honestly considering getting involved with the stock market, my main piece of advice would be to do your due diligence, as you should with anything that's going to put your capital at risk. A huge number of traders or investors that jump in without any research or practice are destined to lose large percentages of their initial investments through lack of self-control or sporadic, uneducated decision-making. My last video detailed 5 books that I'd personally recommend to anybody looking to get started in investing or finance, and I'd wholeheartedly suggest you check that out for a much more in-depth delve into some of these terms and many more. Never invest anything that you wouldn't be 100% willing to lose in a worst-case scenario, and good luck to anybody looking to get started with investing in 2020. Thanks for watching.